Hi, I'm Keith Wilson, founder of Wilson Financial Advisors, and this is Millennial Money Matters, where I teach you the stuff you didn't learn in school, all about financial matters. Today we're going to learn about different types of bank accounts. We'll learn about the differences and the purpose of you having these type of accounts. So let's get started. Dude, you didn't put that up there. Better. All right, before we talk about the different types of bank accounts, you need to be familiar with a few terms. The first term is what we call to be liquid. That's not what I meant. So in the financial world, when we say we need to be liquid, we need to be able to easily assess our money at any time and get to it relatively quickly. So it's not tied up and there's no penalties or fees or anything like that. So to be liquid, just able to get your money at a moment's notice. Next term is what we call time horizon. So time horizon refers to how long is it going to be before you're going to need all of this money that you're saving up for. So for example, let's say you're saving up for a down payment on a car, and you have figured that it would take 6 months before you have the money that you're going to need for the down payment on the car. So your time horizon is 6 months. That is a short time horizon. Or let's say you're saving up for a down payment on a house, and you figure that it's going to take 5 years before you have the amount of money that you're going to need for that down payment on the house. So your time horizon would be 5 years. And that's kind of a medium term or medium time horizon. Or let's say you're 30 years old and you're saving for retirement and you want to retire at 65. Boy, that's 35 years. So your time horizon is 35 years. That is a long-term time horizon. All right, next we want to talk about risks. Everybody's heard of risk. And these type of bank accounts that I'm going to refer to, a lot of people say that they're risk-free or they're safe, and that's not entirely so, because nothing is free from risk or nothing is entirely safe. So when they refer to it as being risk-free, they're really talking about safe from market fluctuations. So you know the stock market goes up and down, and you could lose some or all of what you've invested. But with these type of accounts that I'm talking about, they have a stated interest rate for a specified amount of time. So it doesn't fluctuate like the market does. Now, there is risk of the bank going bankrupt. And what happens if that happens to your money? Well, as long as that bank is a member of FDIC, which is Federal Deposit Insurance Corporation, you are protected up to $250,000. Now that's currently in 2018. That might change later on down the road. So there you have it, what it means to be liquid, your time horizon, and talking about risk. Now let's talk about a checking account. So most everybody has a checking account. It is the most common form of bank account, and you use this to pay your everyday living expenses, your rent, your mortgage, the power bill, groceries, food, clothing, whatever, and usually your paycheck is directly deposited to this checking account, and there's no limit of how many times you can access the money, so it's liquid. It pays usually 0% interest or very, very, very low interest. So it's not something to be used for long-term goals or things like that. Other things to keep in mind with a checking account, they may charge you maintenance fees unless you have a minimum balance. So you need to shop around for banks for low monthly maintenance fees on those. So next is the savings account. So savings account, they earn interest, although it's going to be really, really low, but it does earn interest. You use that for emergency funds. You should also save up 3 to 6 months of your salary in savings for emergencies. You never know when you have a car repair and it's $900, something like that. You don't want to hit your checking account. That would put a dent in that, and you certainly don't want to turn to a credit card. So yes, you need a savings account. You're not going to get rich, but that is your emergency money. So very important to have a savings account. All right, so next up is the money market account. Money market accounts usually pay higher interest than the savings accounts, but they usually have a required minimum amount that you have to open up the account. You have check writing capabilities, that's nice, but you're limited to 6 transactions per month with money market accounts. So a couple things about this. With the money market account, since you have check writing capabilities, there could be a temptation to spend that. You don't want to do that. That's what your checking account's for. So money market accounts could be used for stated goals. Like I said earlier, maybe you're saving for a down payment on a car, down payment on a house, something like that. Usually shorter term. So difference between savings, money market. Savings pay a little bit less, money market's a little bit higher, but you usually have to have more money to open up that account in the money market account. So that gets us to CDs. So CDs, that's short for Certificate of Deposits. So with CDs, they do pay a higher interest rate than savings or money market accounts, but here they have what they call terms, like a 6-month CD. You have to keep that in there for 6 months. You could get 3 months, you can get 6 months, 1 year, 18 months, 2 years. Usually the higher the term, the higher the interest rate. If you back out, let's say you opened up a 1-year CD and 3 months later you decide, boy, I need that money back. I can't wait a year to get that money out. So you go to the bank and say, I need to cash that out. They're going to charge you a penalty. That penalty is typically 6 months of interest that you would have earned. They're going to withhold that from you before they give you the money back. So keep that in mind. If you're considering a CD, try laddering the CDs. And this is what I'm talking about. When we ladder CDs, take out several CDs at different terms. A 3-month, a 6-month, a 1 year, and maybe an 18 months. That way, every 3 months, you're having access to that money. You don't have to wait the whole 1 year. Now, the 1 year or the 18-month CD is going to pay a higher interest rate than the 3-month. But here, you're making sure you've got at least some money available at every 3 months. Let's talk about maturity. So if you opened up a 1-year CD, at the end of 1 year, it is what we call mature. So your CD is matured and you have options. Your options are, hey, let's just roll it over for another 1 year at whatever interest rate you're paying at that time. Or you just say, nope, just give me the money back. There's no penalty, no fee or anything like that. Maybe you want to just take the cash in hand and spend it, or maybe you want to take it to another bank. So when it matures, those are your options. If you don't do anything, it just automatically renews. You usually have a 7-day window before you can decide what to do. But try the laddering. So the CDs are great tools if you've got longer term stated goals. Like we said, maybe that down payment on a house. So if you're saving for, in 5 years, you know you're going to need a down payment on a house, try the laddering CDs and just keep focused on plunking that money away for that goal. So there you have it. Those are your 4 types of bank accounts. Let's just kind of summarize it up with this chart. So with checking accounts, you're going to earn pretty much 0% interest, maybe a very, very, very low interest rate. You use that to pay your bills, everyday spending. Savings accounts, low interest rate, but higher than checking accounts. You're going to use this type of an account for your emergency funds and quick access to your money. Money market accounts. Most likely they pay a higher interest rate than the savings accounts, but also they have a higher minimum to open the account, and you're limited to 6 times per month transactions. Use the money market accounts for a stated goal, maybe a down payment on a car or something like that. CDs or certificate of deposits, they usually pay the highest of all the bank accounts. However, you won't have access for months to years. It depends on which type of CD you open up. We also talked about laddering, so you'll have access every few months to some money. There's no risk in the stock market fluctuation. So there you have it. I hope this helps with different types of bank accounts. Really, you should have all 4 if you have those stated goals that we talked about. Checking account, everyday living expenses, savings account, emergency money. Remember, you should strive for 3 to 6 months in savings of your salary. Money market account, something for a stated goal in the near future. CDs, maybe a little bit longer term goal. CDs are not good for saving for retirement if that's way down the road, because you're not earning enough interest on it. Hope it helps. See you next time. And remember, you're not a snowflake, you're a snowstorm, so get out there and change the world.